You don't understand market structure, you are trading blindly, and that's the truth. Because indicators won't save you, news won't save you either, neither will patterns save you. Because the market only respect one thing, the highs and the lows. So in today teaching, I'm going to show you how to read market structure properly, which is the foundation of all price movement. So let's simplify this way by using the image. You might actually ask the question, or probably you know what it is already. What is the market structure? What is market structure? So in a simple time, I can say market structure actually is the sequence of swing highs and swing lows. That's just it. So what do I mean? I said market structure, it's simple the patterns of highs and lows that price creates on a chart, as you can see in this particular image. So price only does three things. Price does three things. It marks the higher highs, makes the lower lows, and moves sideways. That's just it. Is that a price is moving uptrend or downtrend, or is making sideways? That's just what price does in the market. Now looking at the left side of the image, as you can see on the left side of image, you will see the four building blocks, and which is the higher high, the higher low, the lower high, and the lower low. So these four define trend direction. Let's break this down the more. So then on the right side, the green structure, which is the uptrend. An uptrend actually is formed when price makes higher low, higher high, higher low, and higher high, meaning each pullback holds above the previous low, and each push creates a new higher high. Let me illustrate this. Let me break it down more for you. Looking at this image, imagine the sequence. The price moves up. It creates a highs. Price pulls back, but does not break the previous low. Price pushes again. It breaks previous high. We say that's bullish structure, right? So the rule is this. In an uptrend, look to buy at a higher lows, not at the highs. Most beginners buys the top, while the professionals buys the pullback. Then looking at this image, which is the down section, you can see the red structures, which is a downtrend, is the opposite. Price moves from the lower high, lower low, lower high again, lower low, meaning each rail fails to break the previous high, and each drop creates a new lower low. Illustrating this more or breaking it down more, price drops and makes a low. Price retraces. Price failed to break the previous high. Price drops again, breaks the previous low, which is lower low. So we can say the rule in this particular place is in a downtrend, look to sell at the lower highs, not at the lows. Remember, most beginners also make the same mistake by selling the bottom, while the professionals wait for the retracements to sell. Now, this is a very, very important. You listen? This is very important. I'm teaching decks whereby everybody, professional, new beginners, can learn the right way. Structures tells you when a trend is weakening. For example, if price is an uptrend, which is we're making higher high, higher low, and suddenly it breaks below the last higher low, that's a warning. At the same time, it depends on the time frame that you're using. So that's a warning, meaning that structures shift. The market might transcend from the bullish to bearish. The same applies in reverse. This is why structures comes before indicators. Indicators react. Structures lead you the right way. We go this way. Think of market structure like walking in an upstairs. You live in an upstairs, you're walking your staircase, or you're moving downstairs like you're going down. So the uptrend, which is the step, you put a step, then the small pullback, then you move again, higher step, a small pullback, a higher step. The same way if you're moving down, which is the downtrend, you step down, a small bounce, a lower step, a small bounce, a lower step again. If someone suddenly falls through a step, the direction changes. That structure shifts. I hope this example means something, as in it clarify using our physical walking in the staircase, moving upward. You don't jump with your two legs. You move one before the other, then the next follow. So practically, I will say this: you go to your chart, open your charts, and then mark the swing highs, the recent swing highs, mark the recent swing lows, and then ask yourself this question: did price break above the last highs? That's exactly bullishly, right? It's bullish at. Did price break below the last low? We say it's bearish. That's how you defined your buyers. So before liquidity, that's how you define your buyers before other blocks. That's how you define your buyers before entry. Structure first. So I will say to you, avoid these common mistakes. Trading against the structure one, entering before a confirmed break. Two, confusing small pullbacks with trend reversals. Three, ignoring higher time frame structure. Always check the higher time frame first. Lower time frame entry must align with your higher time frame structure. Remember this: the uptrend, buy the pullbacks; the downtrend, sell the rails. When there is no clarity in highs and lows, please stay out of the markets. Structure gives you direction. Liquidity gives entry. Discipline gives profit. You might know the structure, you might know your liquidity. If you're not disciplined enough, profits will not come in those skills you are learning. So I say this to you: master this first. Remember, structure defines direction. Direction defines buyers. Buyers filters your trade. Everything else is built on it.